In mutual funds, you have different labeling called riskometer, like high risk, low risk, moderate risk. But what does this really mean? How do you interpret the riskometer risk profile of the fund when you want to invest in a mutual fund? It's also required by the mutual fund companies to be updated every month. So the riskometer that you saw last month might be different this month. So the basic principle of riskometer is they're talking about your capital at risk, or your principal at risk, or your original investment at risk, which means that when you have a mutual fund which is categorized as low risk, what they are really talking about is how likely is it for your initial investment to go down immediately post your investment. They're not talking about the returns, they're not talking about the volatility of the returns, they're not talking about upside risk of how quickly your returns can vanish. What they really mean is that if you were to invest today, how likely are you to lose money, your original investment, in a short period of time? Similarly, in a moderate risk, that means it's a relatively moderate chance that you would lose money. But typically equity funds are high risk, which means that it's very well known that the moment you invest your money in a mutual fund which invests solely in equity, in the short term, you're very likely to lose money if the markets turn down. So unless you're comfortable with this aspect of the mutual fund, that let's say you invest X amount of money and in 6 months, the money could potentially half if the market falls dramatically, like in a crisis, then you should not be using these funds. If you worry a lot about whether your investment is safe or not, which means that your original principal should never go down, you must always invest in a low risk mutual fund. Even there is a chance that the money can go down, but it's very, very small. It's as small as if you were to invest in a fixed deposit in a bank and the bank goes under. That can also happen, but that the chance is very limited, and there's a lot of supervision from RBI against this happening. Similarly, in the case of a low risk mutual fund, there's a lot of supervision that this scenario does not materialize, but there is a small chance. So hence, you should always look at the risk profile of your investment objective. How long do you want to stay invested in that fund? How soon you might need that money? And appropriately look at the riskometer of a mutual fund to decide if it's an appropriate mutual fund or not. If you don't want to do it yourself, you can always consult an advisor. But I think these are pretty basic things that anybody who understands a little bit about finance and investing can deal with on their own. So do look at the riskometer of a mutual fund before you make a serious investment, and also monitor it every month, because it can actually potentially change every month, and they're always disclosed on the mutual funds website, so do check it out. But if you want more of such revealing videos about how to do things, what do they actually mean, keep watching for more, because I'll bring you more of them. Thank you very much.